Dividend investing perfected with self-made dividends. All right, so today we're going to take an unconventional wisdom look at dividend investing. So dividend investing, you probably see it all over. If you're into investing at all, you look on the internet, you'll see it everywhere. Plus, even most investment advisors seem to be talking about it all the time. There's hundreds, literally hundreds of blogs just about dividend investing. When you see investment advisors, anytime they're interviewed, you know, very often the first thing they talk about is, oh, the client should switch over to dividend investing, and they see it as a bond alternative. It's really just equity investing. So, and now there's the whole FIRE community, the Financial Independence Retire Earlier group. And they're basically two camps. There's the index people and the dividend people. It's really kind of the two camps, or maybe the third camp, because we got a group that like the all-star investing. But there's really those two camps. So, however, advantages of dividend investing, but there's also some disadvantages, and there's issues that the dividend investors struggle with. Because I read a bunch of their blogs, and you see the issues that they kind of struggle with. And actually, there are some logic errors in how they think. So we're going to kind of go through all that today. We're going to fact check the advantages of dividend investing and see, are they true or not? And we're going to talk about how to fix all the disadvantages of dividend investing and make it perfect. So we have a solution that solves all the problems for it. All right. So dividend investing perfected with self-made dividends. So what you're going to learn today is, why is dividend investing so popular today? What are the advantages of dividend investing? Why is tax on dividends a weird formula? Then we're going to fact check the advantages of dividends true. What are the problems with dividend investing? How can you perfect dividend investing? What are self-made dividends? How are self-made dividends taxed? And then I'm going to do a head-to-head self-made dividends versus ordinary dividends, so you can see a direct comparison. And I'm going to talk about the life of a self-made dividend investor versus an ordinary dividend investor. And we're going to talk about why self-made dividends are the perfect fit for your life. All right, why is dividend investing so popular today? It's been the search for yield. People are just looking for higher yield, especially because, we had like more than 10 years with really low interest rates. And that's what really got popular, and people searching for some other kind of yield. And, the cost of living now is really high. So I think now some people are actually using it as a supplement to their income. They're not getting enough. So they're actually taking money out of their, their retirement fund, the dividend, because they need the extra income. And the FIRE community has been talking about dividend investing a lot. COVID brought some of it out as well, because we found a lot of people in COVID. There's a big surge in people all of a sudden interested in retiring earlier, because now that they were working from home, it just finally struck them, what would it take to stay home permanently? And I think a lot of dividend investors are seeing the same thing. They're thinking, wow, I'll start to save up more and build up some dividends. And also, there's a lot more people now seem to be self-employed. Like there's a good short, 10 or 20% of the workforce really has probably not gone back to work. And a lot of them are doing things that, home-based businesses. There's a lot more of that going on. But a lot of them have lost a lot of income. They're looking for other ways to get income. And then, of course, there's the baby boomers, which is still the largest single group. And they're just about to, the peak of the baby boomer is just about to start retiring this year, right at the peak. So, everyone's talking about retirement income. So there's lots of reasons why dividend investing is really so popular. So what are the advantages, or at least the advantages that the dividend investors claim? So first of all, they say you get paid to wait. You hear that a lot. You get paid to wait because you're getting your dividends while your investments are growing. You watch your dividends rise as you get closer to retirement. And I see lots of bloggers do that. They post about, oh, I made 3,000, 5,000 a month in dividends, or a year in dividends, or whatever. They're bragging about how high their dividends are getting. Then there's passive, dividends are passive income. So they can enhance your lifestyle, or you can reinvest them. They're an inflation hedge. They rise over time, unlike fixed income. It's the lowest tax rates. You can get $68,000 per year in dividends with no tax. A lot of dividend investors talk about that. We'll see if that's true. You get superior returns. You keep your, at least they claim, you keep your shares, and it's income, and you keep your principal, but you keep the number of shares. Okay, so you never sell your share, you're just getting this income. So take advantage of corrections in the bear markets by automatically buying more shares when it's low. And dividend growth is compounding because you keep reinvesting and it compounds. Okay, so these are the main advantages. So let's take a closer look at them all. Now, first of all, let's understand a bit more. So why is dividend investing a weird formula? If you've been investing dividends, outside of RSP and TFSA, you'll notice it's kind of a weird formula, and there's a reason for it. And it's just so you understand it, it's integrated with corporation tax. So first of all, the dividend is grossed up by 38%. It's called a gross up. Okay. So for example, if you get a $10,000 dividend, it actually shows as 13,800 taxable income on your tax return. And you pay tax on the 13,800 at your marginal tax rate. Okay. And what that's supposed to do is it's supposed to approximate the before tax income of the corporation that paid the dividend. Okay. So they're trying to bring your income to what the corporation made before they paid your dividend. And then you get a dividend tax credit, so 15% of the grossed up dividend. So in this case, it'd be 15% of the 13,800 would be 2,070 would be the dividend tax credit that you get. And that's supposed to approximate the tax that the corporation paid. Okay, so that's how it's all integrated. They're trying to put you in a position that what the income before the company paid it to you. So now this is what I'm talking about here. All of this in this video is about eligible dividends, so what you get when you invest in the stock market in public companies. Okay, so there's also a thing called ineligible dividends, and that's when you take a dividend from your own private company. You invest in your own company, you take dividends and stuff, or you earn money from it. That's different. Ineligible dividends are taxed a little bit different. So we're talking here all about eligible dividends, like investing. So what are the problems with investing? And from reading a bunch of blogs on I follow a bunch of dividend investors, and I see kind of what the issues they struggle with. And here's kind of the disadvantages and the issues with it. So for one of them is you pay tax on the income even if you don't need it. So you're saving up for retirement, and yet you're collecting all these dividends. And actually, I get kind of a bit of a perverse laugh about this, because I often see what people will post on social media. I'm up to 5,000 a month now, or I'm trying to get to 4,000 a month of dividends, and they're all proud of themselves. And I feel like posting, oh, sorry to hear that. I guess you're paying a lot of tax you don't need. So remember, these guys they have a full-time job, right? So they're investing on top of it, their retirement income. So they're getting all this 2, 3, 4, 5,000 of a month of dividends, and they're paying tax on that on top of their salary. And the thing is, they don't need this money. This is all for retirement. So it's extra tax. So the companies control the amount, and they might not increase every year. They could stop at any time. So it's a lot of the struggle when you read the dividend blogs is how to get your dividend higher, and it slowly builds up, and it can change. Like, it's not in your control. The company can make changes to it all the time, and they always cheer when it's increased, but basically the companies control it. So, and it's hard to get the income that you want. You're trying to build it up, and a lot of the good companies only pay maybe 2 or 3%. Some pay a bit more in dividends, but let's say the average is maybe 3%. So it's a modest amount that you're getting. So it's hard to get it up to the income that you want, and it's hard to control the number because the companies control it. So the companies also control the timing of dividends. So it's hard to get a regular monthly income out of it. Like, most of them pay quarterly. So what happens is you end up with a high month and 2 low months, and a high month and 2 low months, and so it's hard to get a regular monthly income out of it. And the taxable income is grossed up, so that 138%, which means you get to the higher tax brackets and also the various clawbacks of the government benefits. You get to them with less cash income. So, and the clawbacks on government benefits could be super high. So the worst one is, seniors that have no other income, like low-income seniors that can get this guaranteed income supplement. It's a supplemental pension, part of the old age security that seniors can get. And if you're getting dividends, it's actually clawed back by 69%. It's shocking what happens there, because it's a 50% clawback on the gross up, right? The 138%, it's 50% of that. So there is a bit of a problem with diversification with dividend investing, because it's not all sectors. They tend to be mostly utilities, telecom, consumers, staples, energy, and financials. And generally they're the large, slower growing companies. So the fast growing companies often don't pay dividends because they want to keep reinvesting their money and grow fast. And once the growth in the company is slow, and they're sort of big, more mature companies, that's what you get with dividends. So you tend to not to get a lot of the tech companies. So, now you get like Amazon and Google, and some of these companies don't pay it. So you have a bit of a problem with diversification. The other big problem is, for non-registered investments, all your investments have to be in Canada. So there are some, there's a low tax rate for Canadian dividends on non-registered investments. but you have to be 100% in Canada. So that's, you get into what's called home country bias, where all your investments are in your own country. And you end up choosing the stocks based on dividends, not investing fundamentals. So, really when you're investing, you should invest based on the fundamentals like risk and return and the growth potential. And that's what you should really use. But I find most of the dividend investors are looking mostly at the dividend as the primary reason why they would choose a company. And to me, it should be a very minor issue. So that is an issue. And there's also limited choice for higher dividends. Like if you want something that pays a higher amount, 5, 6, 7, 8%, you want to, there's very limited. And often those are very overvalued companies or really slow growing. And they usually have, if the dividends are that high, there's usually a problem with them. So it's very limited choice for higher dividends. So these are kind of the problems with them. They're not insurmountable, but these are kind of the issues that you get with dividend investing. Now, how can you perfect it? So self-made dividends perfect it. Actually, I'm going to show you, it solves all these problems. It just makes it perfect. So first of all, what are self-made dividends? So basically, all they do is you sell a bit of your investments each month or whatever you need them. So it can be every month. You choose the amount. Only withdraw when you need the cash, not when you don't need it. It's very tax efficient. And this can be automatic with some investments, like mutual funds. You can just do it's an automatic monthly thing. It just comes to your bank account directly, on the 1st or the 15th of every month, and that's it. So it can be done quite easily this way. And basically what it is, it's cash flow, not income. So remember, income is taxable cash flow. So self-made dividends, you're just selling a bit of it, sell a bit of your investments each time. So this actually solves all the problems of dividend investing. And I'm going to explain that here. So first of all, now, how are they taxed? So what happens is when you sell the investment, part of what you're getting is your original capital that you put in, and partly is the capital gain. So let me give you an example. It's the easiest way to understand it. So let's say you invested 500,000 over the years. It's grown to $1 million now. Okay. And you want to take a cash flow of 40,000 a year, based on the 4% rule. So you can take 40,000 out. What's the tax on that? So first of all, what you do is you just sell 40,000 to create it. That's $333 a month, and you get a fixed number every month. It doesn't vary. The companies don't control it. You just set the amount you want. Now, half is your capital. So remember, because out of the million, half 500,000 what you put in, half another 500,000 was what it grew. So out of that 40,000 you take out, 20,000 is tax free. That's just your capital that you're getting back. And the other half, 20,000, is a capital gain. Now, only 50% of capital gains are taxable. So you add 10,000 to your taxable income. And that's whatever your marginal tax rate is, you pay it on 10,000 bucks. So this is kind of the interesting concept. So you're getting 40,000 of cash. Okay. With the self-made dividends, there's 10,000 taxable income on your tax return. With ordinary dividends, it's 55,200 of taxable income. Isn't that shocking, the difference on it? So with the gross up. So, okay, so that's how self-made dividends are taxed. So fact check. So let's go through these 10 advantages of dividends, and I want to see if they're true or not. So this is my view, and I explain why it is. So notice I've got F and T beside them. Pretty well all of them I have false, except is true because they are an inflation hedge. And this thing about withdrawing 68,000 per year with no tax, it depends. It's a more complex answer. But all the other ones, I don't think they're actually true, or at least there's nothing unique about the dividends. So let's go through that. So the first three, you get paid to wait, watch your dividends rise, and it's passive income. Actually, you're getting taxed to wait, right? So, you can take money out of your investments anytime you want if you want to get paid. But here you're getting taxed to wait. You're getting taxed on dividends you don't need before retirement. And you're getting taxable income you may not need. It's not passive income, it's taxable income that you're getting, even though you may not need it. And most of the time, the dividend investor just reinvested anyway, which is really kind of the same as not having a dividend. All the money just stayed in. Like if you rebuy the same company, it's exactly the same. All your money is still in that same company. So it's exactly the same as not having a dividend, except that you're paying some tax. So I see these three as disadvantages, not advantages. You're taxed on the income, even if you don't need it. You need cash flow, not income. Income is taxable cash flow. And so in this case is when you're building up for retirement, you probably don't need the cash flow. So why are you, paying tax on stuff you don't need? So all of these, I see them as disadvantages, not advantages. Because, but also, you can create the same thing by just taking like a self-made dividend. Just take a bit of your money out. If you need money, you could take it out just the same as this, and you'd pay same or less tax. So there's nothing unique about dividends, and in most cases, it's actually a disadvantage to have them. Now, number four, the inflation hedge. So this is true, but it's actually true about all stock market investing. Again, it's nothing unique about dividends, but even dividends rise over time. But generally, stock market returns keep up with inflation, and dividends do the same thing. Over the 200-year, I'll show you the chart in a little bit, the S&P 500 has averaged 7% per year above inflation. So, and if it's higher inflation, it tends to make 7% above that, like over some time. And if it's lower inflation, it makes 7% above that. So the stock market tends to automatically adjust for inflation. And that's because when you have high inflation, companies tend to increase their prices, and their costs go up by inflation, but so their profits tend to go up by inflation as well. So, and if you look at the long-term return of the stock market, it is actually very close to the long-term return, long-term growth of the profits of the companies on the stock market. So that rises for a reason, and dividends rise for the same reason. So yeah, so it does rise with it. Your dividends tend to rise. Most companies that pay dividends increase them most of the years, so it tends to rise. And it is a big problem with fixed income. So like you see a lot of seniors that that have GICs or bonds, this fixed income. They're trying to be conservative in investing, but a lot of them complain about being on a fixed income. I want a fixed income. So the cost of living rises every year, and yet their income is flat. It's like getting a pay cut every year. And the average Canadian is retired for 30 years. That's the average length of retirement. So the average Canadian retires at 62, and then half of the people at 62 make it to 92. So it's 30 years. And over that period of time, the cost of living will double or triple. And if you're getting a fixed income, that's really a problem. So this is a good thing for dividends. It's it's way better than fixed income in most cases. So now, dividends are not the lowest tax rates. So let's just compare this. So there's a whole bunch of smaller tax brackets, but these are kind of the big tax brackets. So 0 to 53,000, and this is Ontario for this year, 2023. And so if you look at the tax rates here, this is Canadian dividends. Of course, global dividends or US dividends are exactly the same as interest, right? So you pay 20, 30, 40, 50% tax. That's what you pay. So Canadian dividends, it's pretty low for people under 100,000. Actually, and it's actually negative tax. They usually try to integrate it, but it's actually gotten a little wonky lately. But it's negative tax on the first 50,000 of income, but then it gets fairly high. And so this is self-made dividends. And the way we compare it, so this is the tax on capital gains and self-made dividends. So the tax it can be zero. So let's say that you've invested and your investments have not gone up. When you take some dividend out of it, it's entirely tax-free. Okay, and if you've gone, let's say it's just gone up, 10 times as much, or it's way higher, then you would get pretty well, all of it is the capital gains rate. So the tax on the self-made dividend can be anywhere between 0 and the capital gains rate, or just under the capital gains rate. So, but this is, if we take just half of the capital gains rate, this is what it is. So notice self-made dividends are low tax in all cases for low and high income people. It's a little higher than dividends for the first 50,000, but after that, it's about the same. And then it's way lower for higher incomes. Now, that's under 65. Over 65, it's completely different. Over 65, what happens is seniors there's various government benefits that everybody gets clawed back on based on your taxable income. And the main ones is GIS, the Guaranteed Income Supplement, the age credit, part of the tax return, and old age security. So those three items are all clawed back. And when you add those on to the dividends, here's what you get. This is 2021 rates, but it's the same kind of thing. So dividends, the first 25,000, you're actually taxed at 62%. It's ridiculous how high that is. And then you have a short area between 25 and 50,000 where you're actually getting negative tax. And then, it's low, and then it gets high again. So it's kind of weird, but self-made dividends, it's just the tax is just low all the way through, even when you're getting benefits clawed back, but it's very little clawback. And so you're still very low tax at all income levels with self-made dividends. But with ordinary dividends, it's actually a real planning issue. And when people are getting a lot of dividends, it's actually really an issue when there's these areas, because you're paying 62% tax, and just a little bit above that it's free, but just a bit less than that you're paying 62%. It's really kind of weird. But self-made dividends, in pretty well all cases, you're paying less tax, except for certain kind of brackets. All right, now let's talk about this 68,000 tax-free. I think a lot of different investors talk about it, think, wow, that's great. But you know what? There's some problems with it. And, let's fact check it. So first of all, the actual number varies. So in Canada for 2023, the amount is 68,000. This is what you can get, no federal tax. Okay. However, the provinces all have a different number. So for example, if you're in Manitoba, you only get 35,000, and then you're starting to pay provincial tax. So some of them here, like Ontario, it's higher than that. So you can get the whole 68,000 with no federal or provincial tax. So, however, you do pay alternative minimum tax because it starts at 55,000. Okay, so when you get to 68,000, you're actually paying this alternative minimum tax. So now, alternative minimum tax, in case you don't know what it is, so when you actually do your tax return, it's probably invisible to you, but you put in all your income, your deductions, your credits. They actually do two completely different formulas for your tax return. One is the standard one that you know about, and then they have an alternative minimum tax that they should calculate, and you pay whichever one is the highest. So if you have 68,000 of dividends and that's all you have, you're going to pay the alternative minimum tax. Now that on anything over 55,000. Okay, so now you can get that back in a future year. If the next year you make a lot less or your income is different, you could claim it back. So it's not necessarily lost. But if you're a dividend income and you're getting, every year, then you never get it back. You end up paying that tax. Now, so let's see. So the tax isn't actually zero. This is why I say it depends. You pay the ultimate minimum tax and you pay some provincial tax. So I have an example. So we have the tax software for 2022, don't have the 2023 one yet. In 2022 is 65,000, not 68 was the amount that you could get out. So, however, it's not actually zero tax. What you pay if you have 65,000 dividends last year, which is basically the same as 68,000 this year, is you pay 2,983 in tax. So you're paying about 5% tax. It's not zero. So you pay no federal tax, but you pay $1,590 in the federal alternative minimum tax. It starts at 55,000. Plus, you pay $643 in the provincial alternative minimum tax, and then you pay $750 for provincial tax for the Ontario health premium. Like it starts at only 20,000. So if you actually want to pay 0, as soon as you get to 20,000 Ontario, you're paying this Ontario health tax. So it's not zero, but it's, we're talking 5% is the tax rate that you're paying. It's pretty low. And these, you might get the alternative minimum tax back. So, okay. Now, here's the bigger problems with this rule, though, is this 68,000 is free is only if you're single and under 65. So if you're not single, if you have a spouse, your spouse gets will lose 28% of the spouse credit for every dollar of dividend that you get. Let's say that you're getting the dividend income, but your spouse has a job or something. They're actually paying, you don't pay any tax, but your spouse is paying 28% tax on your dividend because they get the spousal tax credit and it's clawed back. So it's basically the first 10,500 of dividends you get, they lose 28% of it in tax credit. So the saying is, from $1, I pay no tax on these dividends. Well, no, if you have a spouse, from $1, the spouse is paying 28% on it. So now if both you and your spouse have only dividends, then what happens is the alternative minimum tax starts at only $2,800 a year. So it starts really, really low then. So it doesn't start at 55,000. It starts at 55,000 for one person, but it'll start at 55,000 plus 2,800 when there's two of you getting it. So basically, this rule doesn't apply if you have a spouse, only if you're single. Also, doesn't apply if you're over 65. Like if you have no other income except for dividend, you get a 69% clawback of GIS. So remember, you get 10,000 of dividend. It shows us 13,800 as taxable income. GIS is a 50% clawback on the 13,800. So it's a 69% clawback. It's horrible. Basically, it's not true. So all of this about 68,000 free, it doesn't apply to retirement income once you're over 65. So here's the funny thing about dividend investing. This is why I find it funny is the dividend investors are saving up all through their life, paying tax on dividends they don't need. Finally, they get to retirement, and then they find that all these rules on dividend, dividend investing doesn't work very well for retirees, especially low-income retirees. It doesn't work for them at all. So often you'd say, like, if you're a fairly low-income person, what you should say is, even if you like dividend investing when you're saving up, once you turn 65, you should sell all the dividend investing and invest for very low dividends. because it's getting clawed back at 69%. So also this doesn't apply, if you're in RSP, because of course every dollar is taxed when you withdraw it fully. And it doesn't apply if you're in a corporation either, because there you pay this passive income tax. You're paying 50% tax on dividends inside your corporation. So, but basically the main things are that this 68,000 doesn't apply, it only applies if you're single and under age 65. And that's the thing that everybody misses kind of when they talk about it. So now let's talk about returns, dividend investing versus index investing or all-star investing. Let's just compare them. And the biggest factor actually, so this is assuming it's non-registered investment. Because of course, if it's in RSP, there's no difference in, or TFSA. But if it's non-registered investment, you have to have the dividend investing, you're 100% in Canada, versus index or all-star, you're investing globally or in the US. So that's the main factor in returns. So, returns aren't superior because your dividends are stuck all in Canada. And I'm going to show you the, Canadian stock market has made quite a bit less than the US or the global index over time. Now, if you just do compare in one, like I see a lot of US studies where they show, dividend investing versus index investing and, how they do. And actually, there's been various charts over different time periods and different indexes, and they kind of have different results. Sometimes they show better, sometimes worse. They tended to show better for dividend investing back in the 80s and 90s and early 2000s, whatever it is. And then recently, there's been no advantage at all, if anything, maybe a bit less. So, the index investing is a bit more volatile in both directions. And if you look at dividend investing, kind of what it is, like it's most of the stocks pay dividends. But what some, the stocks that don't are mostly two groups. One is, stocks that are losing money and they're really crappy stocks. So that's good. You don't get them. But also a lot of the top growth stocks don't pay dividends. A lot of the fast growing companies don't pay dividends either. So you're kind of missing some of the bad and some of the good when you're in there. Now, I think the reason why dividend investing looked good back the 80s and 90s and 2000, but not now, is mainly because of what I call the bond bubble, which was 1982 to 2020. So it was almost a 40-year period where interest rates fell from 20% to 1%. So to the degree that dividend investing is a fixed income, kind of is an income thing, then it also benefited from this declining interest rates. So, when interest rates go down, if you have bonds, they're worth more money. So you have a higher return on fixed income on bonds when interest rates are falling. And that also was helping dividends, because if you're getting the same dividend and interest rates are going down, the stock is worth comparatively more. So it was helping over that period of time. But this bond bubble will probably never happen. It's never happened before. It'll probably never happen again. So you shouldn't really look back to the 80s and 90s and 2000s. You should just look more recently. And any other time, you don't really get that, that period. So this is, you just compare this since 1950. And I just want to show you how much less Canada makes. So this is $100 in 1950 invested. The red line here is the Canadian stock market, and $100 would have become 62,000, 9.6% average return. And in Canada, the dividend index is almost exactly the same as the TSX 60, because almost all of them pay dividends, are almost exactly the same. It's funny, if you see a dividend fund and Canadian dividend fund and a Canadian index fund and compare the top 10, you'll find it's basically the same thing. And so this is the US. So the same $100 became 239,000, averaging 10.7, or sorry, 11.7. So, 62,000 in Canada, 239,000 in the US. So it's that much different. Because you're stuck in Canada, you're making a lot lower return. This is, 1.5% less per year, but compounded over the years, it's huge, the difference. So when you're comparing dividend investing to index investing or all-star investing, the main factor is dividend investing, you're stuck in Canada and with a much lower returns. So now this is to show in the US. So let's say you're not thinking about different countries. You're just comparing dividend investing to index investing in the same country. So this is US. So it's got the Vanguard total market return. And then this is the Vanguard. There's two different dividend indexes, the equity index, dividend index, and the dividend growth income. So you compare them, and so the red is the green is the index, and the red and blue are index. So you see, they're pretty close to each other. Index was a little bit ahead, and then fell more, and then here there was the big gain after 2020 was much more that went to the index, but then they fell. Now they're basically the same. So from 2010 until now, it's basically exactly the same. So returns aren't really higher. They're a bit less volatile, a little bit less risky this way, but not really a higher return. And this, I'm just trying to show you the bond bubble that I was showing you. So this is, from 1800 till now. This is show you how consistent stock returns are. The returns have been 6.8, basically 7% real, which is 7% above the stock market. And notice how consistent it is over the long run. But this is bonds. So bonds, remember, actually from 1940 to 1980 lost half of their value after inflation. So if you invest 10,000 in bonds in 1940, leave it for 40 years. 40 years later, you can buy half of what you could before. It was a total disaster. And then we had this bond bubble from 82 to 2020, where interest rates came down pretty well every year, and the return on bonds, wasn't that much less than stocks. But this part here, you have to realize, is a weird thing that's never happened before and will never happen again. So whenever you look at fixed income, which kind of includes dividend, you really shouldn't look at the period from 82 to 2020, because it's artificially inflated by this declining interest rate. All right, so in general, it's index or all-star investing beats dividend investing. It's probably high return. And again, main thing is you're investing globally, because 100% in Canada with dividend investing. You invest based on the fundamentals, not for the dividends. And, dividend investing, I see what these bloggers are doing. They're picking their company primarily for the dividend, but really you should be looking at the fundamentals. So what you should do is invest for the highest reliable long-term return after tax, and don't pay extra. Like if you don't pay anything, don't buy a more expensive company just because it pays dividend. Basically, you shouldn't look at the dividend. Basically, if it's one of many factors, and just invest for the highest long-term total return after tax. That's what you should invest for. Now, RSP, all this talk has been about non-registered. So an RSP, if you're investing in the RSP and TFSA, dividend investing and index investing are actually quite similar. They're both just investing in the stock market. So dividends, basically, if it's RSP or TFSA, all the dividends stay invested and are irrelevant. Doesn't matter if you're getting them or not; they stay in there, right? And so basically, dividend investing is just like index investing, except it's a smaller universe. Most of the stocks pay dividends, but not all of them. So basically, all the dividend stocks are also part of index investing. You can buy them exactly the same, but index investors and all-star investors just have a lot more options as well. So S&P 500, about 75% of the companies pay dividends. Globally, it's about 53%. In Canada, 95% of the TSX 60 pays dividends. And that's, like I say, the Canadian dividend funds are almost exactly equal to the index. So this is the advice that I would give you, and it's Warren Buffett's advice. It's be agnostic about dividends. So with our investments, I have to say, we're invested with portfolio managers trying to find the all-star fund managers, the world's best investors. And I would say that I am unaware of what the dividends are with the companies that we hold. Now, there are, of course, because you're buying equities, you're going to get lots of dividends. You can't avoid them. Lots of good stocks pay dividend. You're going to have a lot of stocks that pay dividends, but I don't actually know what the dividend payout is in there. It's just automatically reinvested. Doesn't really matter. It's just fund managers are choosing all the stocks based on the best long-term total return after tax. Don't worry about whether it's dividends or not. Dividends are just one of all the factors. Okay. Now let's look at the last three. So dividends are the last three issues here. So now dividends are actually withdrawals from your investments. So these three areas, you keep your shares and take advantage of corrections and dividend compounding. These all are based on the same logic error that dividend investors have. So there is no new principle. There's no principle when you're investing in equity investing. So in fact, you're owning shares. You don't have principle and the dividends are income. That's what you get with bonds and GICs. You have principal, your principal is guaranteed, and you're getting interest. So here, your money is just invested. So you just think of your investment as the amount of money that you have invested. So a dividend is a withdrawal from your investments. That's all it is. And then it's taxed in a certain way. So yeah, you keep your shares, but it really doesn't matter. I'm going to show you this example in a minute, but it's just a withdrawal from your investments. Taking advantage of corrections in bear markets. The idea is you get your dividend and it says, well, you're buying more shares when it's low. But really you're not, because the dividend is you're taking money out of the investment and then you're putting it right back in. So it's not new money. So reinvesting dividends is not buying low, because it's both a withdrawal and a new investment. So you're both buying low and you're selling low by taking money out while your company's low. It's not really any different. Now, dividend growth compounding, saying it compounds, but that's really not new. So remember, dividends aren't new money. They're not new money. It's money that's part of your investment, and you took some out as a dividend, and now maybe you put it back in, and it's compounds, but it's actually not new money. So if you had no dividend at all, your investment would be compounding exactly the same as if you get dividends and compound them. So this is just a logic error that they're kind of thinking of as income, as this, the dividends are somehow free extra money or new money that they're getting, but it's not. So dividends are withdrawals from investments. That's all they are. So dividends versus selling shares is really the same thing, except taxed a little bit differently. So both are withdrawals from your investments. You just look at the investments, the dollar amount you have, you get something out. So to show you what it actually is, there is a definition of it. The term is called the ex-dividend date. So if you've looked at a stock when it pays a dividend, here's what happened. The stock goes down by the amount of the dividend. So there's a date shortly before the dividend is actually paid out, where it's whoever has the stock the day before gets the dividend, and whoever has it the day after doesn't. Okay, that's what it's called, the ex-dividend date, without the dividend. Okay, so dividend versus selling shares, both of them are withdrawals. And here it is. So I have a stock worth $10 a share. It pays a 50-cent dividend. So my shares immediately drop to $9.50 per share. And if you look at shares, it'll actually happen. Like usually on the day, the dividend isn't necessarily that big as a comparison, but it'll drop that much. Plus whatever's happening that day, it may go up or down. So it won't be exactly that difference. But this effect, it's paid out 50 cents. So the shares will drop out 50 cents because the company is worth that much less because it took out the extra cash, right? Now you have shares worth $9.50 plus you have cash of 50 cents, you got $10. So your dividends did not change your net worth. It's not new money. It's just that you've done a withdrawal from your investment. That's all it is. Now, if instead of that, you sell 50 cents, let's say your stock doesn't pay a dividend, and you sell 50 cents, so then you have shares worth $9.50 and cash of 50 cents, $10. It's exactly the same thing. So selling the amount, the same amount as the dividend, is the same thing as getting a dividend, except it's taxed less, in most cases. Also, reinvesting the dividend, which is done most of the time. Some of you even have DRIPs, it's called dividend reinvestment plans, where it's automatically reinvested. That's really the same as no dividend, except that you're paying some tax on it. So it'd be better if they didn't have a dividend at all and just left your money invested, because you'd be exactly the same position without having the tax. So both cases you stay invested, with reinvesting a dividend or not having a dividend. So here's what happens. So let's say in this case, you got the 50-cent dividend, use it to buy more shares. Now you have 1.05 shares instead of one. They're worth $9.50 each, so that's worth $10. Versus if you had no dividend, you'd still have the one share at $10. It's worth $10. You're in exactly the same position, but but you just paid tax on it. So no dividend is the same as reinvesting the dividend, except that you don't pay tax on it. All right. So this is the flaw, the logic error of a dividend investors. They're thinking it's new money that you're getting somehow, but it's not. It's just a withdrawal from their investments that's taxed, and then whatever they do with it. But dividends are not new money. I just want to explain this a bit more. So companies have four things they could do with their profits. They can reinvest it in their business. They can buy another company. They can buy back some shares of their own company, or they can pay out dividends. And all four uses of cash contribute to the total return. So all of them are a plus for you in similar amounts, most likely. Companies did not pay dividends. They could grow faster by reinvesting that money and growing the profits. Now, many companies are doing share buybacks instead of dividends today. It's more tax efficient than paying a dividend, and the owners own a larger portion of the company. So now they buy back some of their own shares, like basically people willing to sell shares that are selling them anyway. They just buy those shares and take them off the market. So the number of shares declines. So you have the same amount invested, but you own a bigger piece of the company, and your shares are worth a little bit more. Now, there's been some weird political stuff with people being against share buybacks, but really share buybacks are a version of dividends, right? It's except you pay less tax on it. They're paying out some money to increase the value of their company. Or in this case, dividends are paying the money out to dividends goes to all investors, share buybacks goes to only cash goes to only certain investors. But it is more tax efficient on that way. You don't pay tax on the dividend. Now, another example, Warren Buffett's Berkshire Hathaway doesn't pay a dividend. Now, it's a company that you'd think would because it is a large, more mature, slower, steady growing company, and it's got lots of cash, so they easily could pay a dividend. And it's the kind of company that you would expect might pay a dividend, but they don't. And basically, he allocates capital. His belief is that his special skill is allocating capital, and he allocates it more effectively than pretty well anybody else. So better than the investors are. So basically, the investors are better off leaving their money invested and letting him allocate the capital. So he does not pay a dividend. He's never paid a dividend from his company. So now he could, maybe he will someday, but he hasn't for a very specific reason. And it's interesting to see it from this perspective. It's part of why his company has grown fast. They keep reinvesting the money and they don't pay the money out as a dividend. All right, now we've seen the true and the false. So most of the advantages claimed of dividend investing aren't actually true or are not unique to dividend. But and there are some problems with it, but we can fix all those problems. So self-made dividends fixes all the problems. It's dividend investing perfected. So let's do, first of all, do a head-to-head here. So self-made dividends versus ordinary dividends. So with self-made dividends, you decide the amount of dividend you receive. You can start, stop, and change the dividend anytime you want. The companies don't have any effect on it. You're not forced to pay tax on dividends you don't need. If you don't need it, just have zero. Just don't take anything out. You can invest property based on risk return instead of chasing yield. You can avoid buying expensive investments to get a higher dividend. You can properly diversify globally instead of 100% in Canada. For seniors, the clawback of governments from ordinary dividends is 5 to 6 times higher on ordinary dividends than it is on self-made dividends. It's way lower. You pay less tax than on ordinary dividends, or sometimes no tax. Like in most cases, you pay less. And self-made dividends are the lowest tax type of investment income because they're based on deferred capital gains. So the underlying power behind them is not capital gains, but deferred capital gains. Because remember, it's when you sell them. So it's not the capital gains I pay today. I'm selling a bit over time. Most of the dividends, most of the withdrawals are years way down the road. So I've seen people compare the dividend tax rate to capital gains tax rate, which varies. However, if you compare, dividends today, tax today, to capital gains tax 20 or 30 years from now, it's the deferred capital gain is the lowest tax. And that's the underlying power behind self-made dividends. So self-made dividends give you cash flow, not income. Okay, income is taxable. Dividends are taxable cash flow. Self-made dividends are not a cash flow. Now, we can fix all the problems with dividend investing with self-made dividends. So you pay tax on the income only if you don't need it. Remember, these are the 10 problems with dividend investing. You control the amount with self-made dividends. It's easy to get the income, the exact dollar amount you want. You just choose the dollar amount, and that's the amount you take. You don't have to constantly fight with all this. How do I get the right amount of income? You control the timing of dividends, so you get your self-made dividend is for most people with self-made dividends, you're getting it automatically on the first of the month sent directly to your bank account, and it happens automatically. It's the exact amount that you want. So the taxable income is not grossed up. So only 50% of the capital gain is your taxable income. So the taxable income is way lower than with dividends. So which means you reach the higher tax brackets and the clawbacks with a lot less cash income. So remember the example we had with 40,000 of cash, it was 55,000 of taxable income with an ordinary dividend, but only 10,000 of taxable income with a self-made dividend. So now there's very low clawbacks of government benefits, generally only 12% clawback, remember, of GIS, while ordinary dividends of 69%. Diversification is unlimited. You can buy anything you want. There's no restriction here on what investments you can buy. You can invest globally, so you don't have the home country bias. You choose stocks based on their underlying fundamentals. And there's, unlimited choice for higher dividends because you just choose a higher, you just choose a higher dividend, right? So you don't have to change investments at all to get a higher dividend. So notice all the problems with dividend investing are gone with self-made dividends. We fixed them all, and we're paying less tax, have full control, invest globally. It's just way better in every way. So here's the head-to-head. I looked at these 10 factors: self-made dividends versus ordinary dividends. Who wins? So lowest tax, self-made dividends win in the vast majority of cases. Superior returns, self-made dividends work, right? Because you're investing outside of investing globally. You decide the amount, so self-made dividends work. Income does not change unless you change it. You decide the frequency. You can start, stop, and change anytime. Tax on income. You're not taxed on income that you don't need. You can diversify globally. There's low clawbacks of government benefits, and it's cash flow, not income. So on a score, I've got self-made dividends 10, ordinary dividends 0. So it's basically, it's better than self-made dividends are better than ordinary dividends in every way. So there's really no advantage in any case for ordinary dividends. I think anybody should choose self-made dividends instead. And it's just actually way easier. Now let's talk about the life of a dividend investor. And this is actually kind of funny because I see this, from the lives, the dividend investing bloggers. There's hundreds of them, and they kind of put their life out on their blog. And so they're proud of talking about how they've built up to $2,000 a month, and I'm trying to get up to $4,000 a month of dividends, but it's all tax that they're paying on it, right? They reinvest all the dividends because they don't need the cash flow, but they're paying tax on this every year. So, and they're tempted to spend some of the dividends because they're getting the cash constantly. And if they did, there would be less for retirement. So, and they're invested 100% in Canada. So that's kind of what their life is. And then when they retire, the income is usually too low for their desired lifestyle. So they may have to sell some investments, or, actually they often make it up by taking more from RSP and TFSA and stuff. Because, so most dividend stocks pay less than, the 4% rule is, how much you might take out of investments is kind of a sustainable amount if you have an equity portfolio in retirement. And most dividends pay less than that. So for most dividend investors, it's hard to get as much as they want from their dividends. So income goes up and down. Usually have one high month and two low months. So they're, retirement, that's probably mostly an annoyance, but it is there. So you have no control on the amount or timing of the dividend, and you're tempted to chase yield by buying high dividend stocks, which are actually overvalued and low growth. And I do see that when you read these dividend bloggers, they're kind of thinking, oh, maybe, like I'm only getting, average 3% dividend on my investing. Maybe I could get it higher. I could buy a couple of these really high dividend crappy stocks, and they're trying to get their dividend up. But, that's part of the life of being a dividend investor is you struggle with all this stuff. Now, if a self-made dividend investor, here's what life is like. Like while you're saving for investment or saving for retirement, your dividend is 0, right? You don't take anything. You just let all your investments grow. For retirement, you're not taking any out. You're not tempted to, you're not paying tax on any of it, except, well, obviously you still get some dividends because there's, most stocks have some dividend. But you're not taking anything out so that you pay way less tax. You can invest globally or the US and invest based on the fundamentals of risk and return and growth. And you're not even considering the dividend, or it's a very minor factor, but you're just saving for retirement. So once you retire, you decide on what the amount that you want, and you just start retirement on the exact amount. It's to the penny, the exact amount you want. That's what you get. And you get it automatically every month. You can start it immediately. So, like these dividend investors are building up 5,000, 2,000, 3,000, 4,000, 5,000 a month that they're trying to get to. Well, for self-made dividend, it's 0 until you retire. And then the day you retire, it jumps up to 5,000 a month or whatever number you want. So again, now the 4% rule is kind of a guideline. So maybe you want to start with that number. You can do it any number that you want. So every month you get exactly the same amount. You have full control of the exact amount and timing. You can reduce easily. You can reduce this income easily if you have other income. So let's say you get a side hustle or you get a part-time job you're going to do for a year or two, just take a bit less. It's very easy to change it. If you're getting regular dividends, you got to change your dividends around or reinvest more dividends or something. Also, if you want a bit more, when you're taking a bigger trip, just increase your self-made dividend, just take a bit more out. So why are self-made dividends a perfect fit for your life? We've done like literally thousands of retirement plans. And it's just a perfect fit because you have zero dividends and no unnecessary tax while you're saving for retirement. You start the exact retirement that you want. You choose a sustainable number, like 4% or so, whatever amount you choose that's sustainable. It's easy to adjust your retirement income to stay sustainable. You just adjust what you take. And you can adjust your retirement income whenever you want for any reason. You can make it higher or lower. So it's just a perfect fit. So self-made dividends, it's the perfect fit for your desired lifestyle, when you retire. All right, so that's my talk today. So what we learned today is why is dividend investing so popular? What are the advantages, or at least the claimed advantages of dividend investing? Why is tax on dividends a weird formula? We fact-checked all the advantages of dividends to see if they're true. What are the problems with dividend investing? And then how can you perfect dividend investing? We get solving all the problems. And we talked about self-made dividends. What are they? How are they taxed? We did a head-to-head comparison of self-made dividends to ordinary dividends. We talked about the life of a self-made dividend investor versus ordinary dividend investor. And then why are self-made dividends a perfect fit for your life? So thanks for listening. My name is Ed Rempel. My blog is Unconventional Wisdom. It's the #1 blog in Canada for a financial planner. It's edrempel.com. Also, I have a blog and a podcast, or a podcast on YouTube. The podcast is on 27 different sites, edrempel.com/listen, and you'll see the whole list. Pick your favorite podcast source. YouTube is edrempel.com/watch. Or if you're interested in potentially talking to us about working with us to, create your plan and create your own future, you can ask for a free 30-minute consultation on my blog, edrempel.com/talk. So thanks again for listening, and we'll see you next week.